Good morning. Welcome to Stock Market Today. It's Tuesday, October 22nd, 2019. I am your host, Dan Russo, the Chief Market Strategist at Shaken Analytics. Find me on Twitter. I'm at Dan_Russo_CMT. Stock Market Today brought to you today and every day by Shaken Analytics. Head over to shakenanalytics.com/today. Sign up for a free email. Follow along with this show and get daily stock ideas for you to consider in your inbox every trading day before the market opens. So U.S. equities were higher in Monday's trading, ending near the best levels of the session. Treasuries were weaker with the curve steepening. The dollar was stronger versus both the yen and the euro. Gold ended down 40 basis points. WTI crude settled down 70 basis points. Most sectors were higher on the day, led by energy and financials, although materials and healthcare did underperform. And as we get to the desk this morning, it's a bit of a mixed opening. Futures are up about 10 basis points on the S&P. Dow futures are trading lower. Treasuries are mostly stronger with some curve flattening. Dollar is little changed against the yen, slightly stronger against the euro. Sterling is weaker ahead of this afternoon's Brexit votes. Gold is up 10 basis points. WTI crude is adding on to the day, adding 60 basis points to get things started today. And as I sit here and look at the structure of the S&P 500, we are still knocking on the door at the resistance level. Haven't quite been able to push through yet, but knocking on the door. The title of my note today is Pushing on a String. Key support now at the 200-day moving average near 28.68, and then more importantly, the August lows near 28.20. Resistance near that 3,000 level. We've been talking about it. I feel like a bit of a broken record, but I can't change what is for the marketplace. Resistance is at 3,000. So far, it's holding firm. RSI is holding bullish ranges, and that is encouraging. And Shaken money flow remains on a bearish reading, although I will note we had a nice rebound here over the past couple of days. We'll see if we can get money flow to push back into the positive territory to get back in gear with our momentum indicator as RSI does hold bullish ranges. Now, our market in a minute. What are we talking about in the note today to Shaken Analytics clients? Most sectors close higher as SPY tests resistance once again. We hit on that. Bond proxies consolidate on a relative basis. It's Tuesday. I'm doing my relative strength work today, and we're going to go through a couple of the themes that I'm seeing both from a trend perspective as well as some near-term potential changes as cyclical sectors show signs of improvement in the near term. Energy, however, remains weak from a trend perspective. Futures, as I said, point to a bit of a mixed open here this morning. Looking at the major indices now, power bars for the Dow still skewed in favor of the bears here. 4 bulls, 7 bearish stocks after the Dow adds 21 basis points. Dow being held back a bit here by Boeing in the near term. S&P 500 adds 70 basis points, 111 bulls, 96 bears, so slight improvement there on the day. NASDAQ an outperformer, 24-13 bulls to bears, and small caps, the big outperformer on the day, up nearly 1%, a big boost to the ratio here. 628 bulls, 341 bears. Bonds down tick. Energy had a nice day. Up 1.8%. However, if we look at the fundamentals within the energy sector, and we're going to take a look at the trends here a little bit later in the show, energy still bearish. 15 bearish or very bearish stocks, only 1 bullish or very bullish stock rather. According to the Shaken Power Bar, small cap stocks and large cap stocks remain somewhat bullish. The major markets across the board are mixed. So mixed as the index chops around. Stock of the day today comes to us from the banks, right? This is an area we've been watching closely for the past week and a half, and we're going to continue to watch closely here. But East West Bank Corp, EWBC, the ticker symbol. Remember, this is auto-generated based on our algorithm, based on the power gauge rating, which is very bullish. Due to very attractive financial metrics, very strong earnings performance, and strong price volume activity. 20 factors, 5 in each of these categories bring us this very bullish rating. Strong trend as the stock is above the long-term trend line, and a strong industry group as the banks have been strong. However, we're not there yet. Market and model not in agreement as East West Bank, EWBC, continues to underperform the market. I think there are better opportunities out there in the banks. Remember, we've been talking about seeing improving relative strength across some of the large banks and the regional banks. I think you want to look elsewhere if you're looking for your bank exposure. I think you want to add East West to a bullish watch list. And if we can get some relative strength out of the stock, maybe then it becomes a little bit more compelling. But for me, this trend is still lower. Looks like there's still some more work to do. I'm going to add it to a watch list. I think there are better names out there for you to consider. I mean, look at a name like Valley, VLY, much more compelling as it is now outperforming the market within the bank's industry group. Our sector tracker now. movement of the major sectors over the last 5 days. And we can see here that all of the major sectors are higher over the last 5 days, led by those financials. Again, this is a theme that is emerging, right? Financials for a long time have been underperforming the market. Solid fundamentals have not been recognized by the market. The group has been an underperformer, largely held in check by the banks, right? Insurance stocks were outperforming, the banks were underperforming, kind of had this underperforming trend for the financials. What we're starting to see now is a bit of a rotation within the financials, actually. We're starting to see the banks do better. And if you look at the insurance stocks, look at KIE, starting to see a bit of underperformance. So that's an interesting theme, still in progress, still developing. Going to be watching it closely here for those rotations, kind of similar to what we were talking about in tech, right? Remember when software started to underperform as the semis started to take off? Potentially similar dynamic at play here for the fins. Real estate continuing to do well despite the backup in yields. Healthcare, comms, and discretionary round out the top of the list. Industrials, utes, materials are middle of the road. Defensive staples continue to underperform with a little bit of a more risk appetite in the marketplace. Energy still near the bottom of the list. And tech, well, we want to see tech do better. If you're bullish, you want to see tech outperforming. It is over 20% of the S&P 500. Now, we've been bearish on energy. We remain bearish on energy. We looked at oil field services yesterday. Today, we're going to look at EMP. Our industry in focus, oil and gas exploration and production, has been underperforming the S&P 500 over the past 6 months by over 33%, nearly 33.5%. And we think that that trend is likely to continue because the power bar ratio, which measures future potential, very weak. 29 bearish or very bearish stocks, 4 bullish or very bullish stocks. Currently ranked number 20 of 21 subsectors, down 1 slot over the past week. The only group that's worse is the one that we looked at yesterday. Some of the indicative names there that you want to avoid or potentially look for bearish opportunities when the setup is there. Noble, very bearish rating. Concha, CXO, very bearish rating. And Continental Resources, CLR, very bearish rating. And if we look at the group, XOP is the ETF that measures the performance of this group as a whole, and you can quickly see bearish ETF power gauge rating, weak trend with the fund below a declining long-term trend line. Underperforming the market for more than a year now. So our bearish rating is met with underperformance. Fund is overbought within the context of this downtrend with persistently bearish money flow. Does that look like something you want to own? Does that look like anything remotely like anything you'd want to go bottom fishing in? Absolutely not. I think you want to look for opportunities. I'm highlighting ExxonMobil in my note today to Chaikin Analytics clients as the type of stock you want to avoid or potentially look for bearish opportunities. Let's hit what's trending now. Yesterday's S&P 500 gainers and losers are movers and shakers. Cody up over 13% as they announced that they are pursuing or evaluating strategic alternatives for certain portions of their business, which will allow them to lower their leverage. Investors like what they heard there, stock up over 13%. Halliburton's earnings sent that stock higher by 6.4%. So again, part of that energy complex, when you see these rallies to overbought conditions, might want to think about a bearish opportunity. Halliburton up 6.4% remains bearish. Helmerich and Payne, another energy stock, right? Rallied with the energy group yesterday, but remains very bearish, up 5%. EOG actually caught a downgrade yesterday, but the strength in the energy stocks took the stock higher by 5%. Yesterday. And then Keys rounds out the list of leaders. Positive comments out of a large brokerage firm sent that stock higher by 4.82%. Boeing continues to come under pressure as headlines continue to be negative around the 737 MAX. And that's what's weighing on the Dow. Remember, the Dow is a price-weighted index, so a high-priced stock like Boeing weighs on the group disproportionately, and that is why the Dow was underperforming yesterday. CME, there was an article in Vanity Fair that highlighted some potential insider trading activity around S&P futures, sent that stock lower by 3% yesterday. ABC and McKesson, MCK, healthcare drug distribution stocks under pressure due to their opioid settlement news that came out yesterday, and Ross Stores, no real news there, to send that stock lower by 2.76%. Let's take a look at what we're writing about in the note today. All right, it's relative strength day. It's Tuesday. Bond proxies are consolidating, right? We've been talking about how the 10-year yield has begun to build a base above support at the 1.5 level, right? And as that base builds and yields start to drift higher, we're starting to see the bond proxy areas of the market come under some pressure and consolidate. So I just wanted to kind of give it to you here in one chart. Top panel, we're looking at XLU relative to the SPY. So utilities relative to the S&P 500. And so it's been leadership since late April, early May, right? Trending higher. But we're bumping our heads now on these December highs, these December relative highs, and we've started to consolidate, right? Utilities have been an area of the market that we've liked. Fundamentals still look good, but we are paying attention to, again, to early signs of potential shifts. And if rates do gain traction to the upside, it stands to reason that the utilities are going to come under pressure, right? If money starts to rotate further towards the cyclicals, these defensives are likely to come under pressure. And we're starting to see early signs of that. Same goes for real estate, right? Down here at the bottom of the chart, XLRE relative to the SPY. So real estate relative to the S&P 500. Again, been leadership, bullish fundamentals, been an area of the market that we've liked. It's been a good area of outperformance. But now we've drifted into this consolidation, right? Not a change of trend just yet, but something we want to be paying attention to, right? Same as we want to be paying attention to early signs of relative strength in the banks at the expense of early signs of relative weakness in insurance, right? Watching for these trends, trying to catch the shifts for as long as possible, as early as possible, and determine if they are sustainable. One of the ways that we try to find these shifts is by looking at relative rotation on a shorter term basis, right? StockCharts users, you should be familiar with this chart. We're looking at the relative rotation of the S&P 500 sectors, short-term in nature, looking at a week's worth of rotation here to get a sign of potentially early shifts in the trend, potentially early changes taking place, right? And the way we read this is the upper right-hand quadrant is the sectors of the market that are leading, right? So right now, discretionary is leading, healthcare is leading, and tech is leading on a short-term basis. Right? The areas of the market that are weakening, well, what are we talking about here? The bond proxies, real estate, and UTs, as well as the defensive consumer staples are starting to show early signs of weakening. Right? The lagging areas of the market down here in the lower left, energy, no surprise. Materials, right? These are areas of the market that have been lagging. And the areas of the market that are improving, comm services, industrials, and financials. So this is right here. This is your cyclical improvements right here. And when we say cyclicals are improving in the near term, this is what we're talking about. We're starting to see some early signs of industrials. We're starting to see some early signs of financials, right? We've been banging the drum on financials for about a week and a half now. Materials, not quite there yet, but something we're keeping an eye on, especially as the dollar has been weakening. Dollar weakness could lend a bid to commodities to which the materials are levered, right? So there's that intermarket analysis starting to play through as well. And in fairness to energy, it's moving in the right direction on a very short-term basis, but that downtrend is still very much in track. And if you notice, the closer we are to the midpoint line, the closer we're tracking to the S&P 500. Energy way out here on the periphery shows you just how much it's been a lagging part of the market on a relative basis. So very early signs, but not quite there yet. And here's why. Let's take a look at energy. Trend in energy on an absolute basis remains down below a declining 200-day moving average. Trying to bounce from support here, but still a ton of work to do. RSI of energy remains in bearish ranges, even with this rally of late, RSI not ticking above 50. There's the longer term relative trend, right? You can ski down that slope. It remains very much in place and likely to persist because XLE has a very bearish Chaikin Power Gauge ETF rating, 15 bearish stocks, only one bullish stock in the group. We think it's likely to continue. That's going to wrap it up for today. Head over to the site to sign up for the email. Have a great Tuesday. I'll be back tomorrow.
Today's market volatility provides savvy traders and active investors with an abundance of profitable opportunities. At the Traders Expo Las Vegas, November 7th through 9th, over 75 of the most respected traders in the world, including Dennis Gartman, Tom Sosnoff, Todd Gordon, and Tom DeMark, will explain how they're adapting their strategies and share the specific trading opportunities they've identified in equities, options, forex, futures, cryptocurrencies, and more. Claim your free pass to join them at tradersexpo.com.